Hey everyone! Welcome back to our channel. If you're curious about the world of decentralized finance and how it's changing the landscape of traditional finance, you're in the right place. Today, we're diving into a fascinating topic, protocol-owned liquidity, or POL for short. It's a term that's been gaining traction in the crypto space, and understanding it can give you a better grasp of how decentralized protocols operate. So, let's break it down together. But first, let me ask you this. Have you ever wondered how decentralized finance protocols maintain liquidity without relying solely on external liquidity providers? What if I told you that there's a model that allows protocols to own their liquidity? That's where POL comes in. Let's explore what that means and why it matters. Alright, let's start with the basics. So, what exactly is protocol-owned liquidity? In simple terms, POL refers to liquidity that is owned and controlled by a protocol rather than provided by external market participants or liquidity providers. This is revolutionary because it allows the protocol to stabilize its ecosystem and reduce reliance on external factors. To better understand POL, let's look at a traditional liquidity model. Typically, decentralized finance platforms rely on users to provide liquidity by depositing their assets into liquidity pools. In return, these liquidity providers earn fees and sometimes even governance tokens. While this model is effective, it can lead to issues like liquidity being pulled out suddenly, which can create price volatility for the assets involved. Now, imagine a scenario where a protocol can fund its own liquidity. With POL, this is achieved through mechanisms like treasury management and incentive structures that promote long-term liquidity provisioning. For instance, some protocols acquire liquidity through bonding, where users can purchase protocol tokens at a discount in exchange for providing liquidity. This creates a win-win situation. Users get tokens at a lower price, and the protocol secures much-needed liquidity. Let's take a closer look at an example. Consider the protocol Olympus DAO, which is one of the early adopters of the POL model. Olympus introduced a bonding mechanism that allows users to buy OHM tokens in exchange for liquidity provider tokens or other assets. In this way, Olympus can accumulate its liquidity without relying heavily on external liquidity providers. The liquidity is then used to facilitate trades, ensuring that the protocol can support its own ecosystem. Now, let's talk about the benefits of POL. Firstly, it enhances stability. Since the protocol owns its liquidity, it can better manage price fluctuations and maintain a stable market for its assets. This is particularly important in the volatile world of cryptocurrencies, where sudden price swings can lead to panic selling and reduced confidence in a protocol. Secondly, POL can lead to increased governance. When liquidity is owned by the protocol, it allows for more effective decision-making processes. Protocol developers can better align incentives and ensure that the liquidity they control is used for long-term growth rather than short-term profits. Lastly, POL can improve sustainability. By creating a self-sustaining liquidity model, protocols can reduce their dependence on external liquidity providers who may not always act in the best interest of the protocol. This can lead to a more resilient ecosystem where the protocol can thrive without constantly seeking external funding. But it's not all sunshine and rainbows. There are also challenges associated with POL. For one, protocols must have a well-thought-out strategy to acquire and manage liquidity. Poorly managed liquidity can lead to inefficiencies or a lack of responsiveness to market changes. Additionally, the opportunity cost for liquidity providers must be considered. When users lock their assets into a protocol, they might miss out on other lucrative opportunities elsewhere in the market. This is why it's crucial for protocols to offer competitive incentives that attract and retain liquidity. So, how do we see POL evolving in the future? As more protocols adopt this model, we can expect increased innovation in the way liquidity is managed. New mechanisms and strategies will likely emerge, leading to more robust and resilient decentralized finance ecosystems. It'll be exciting to see how protocols balance their liquidity needs with the interests of their users moving forward. In summary, protocol-owned liquidity is a game-changing concept in the decentralized finance space. By allowing protocols to own and manage their liquidity, we can see increased stability, better governance, and a more sustainable ecosystem. However, like any model, it comes with its own set of challenges that need to be addressed. So, what do you think about protocol-owned liquidity? Are you excited to see how this will shape the future of decentralized finance? Let us know your thoughts in the comments below. And if you found this video informative, don't forget to give us a thumbs up and subscribe to our channel for more educational content on cryptocurrencies and decentralized finance. Thanks for watching, and we'll see you next time.